2026 is shaping up to be one of the most unpredictable financial years in a decade. Global GDP growth is slowing. The OECD projects it down to just 2.9%. Inflation is cooling. Interest rates are expected to fall. AI is reshaping entire industries, and investors everywhere are asking the same question: what do I do next? Today, I'm going to walk you through exactly how I would invest in 2026, step by step. No hype, no get-rich-quick promises, just a clear blueprint built on data, discipline, and a little bit of courage. The intense ticking sound fades into a calmer, more deliberate rhythm. Before we dive into strategies, I need to make something clear. Nobody knows the future, but we can prepare for it. Markets reward those who plan ahead, who control their emotions, and who understand the difference between noise and opportunity. In 2026, the opportunities are real, but so are the risks, with new universal tariffs threatening to send global trade into a decline for the first time in years. So let's build this from the ground up. Step 1, a boring word nobody likes to hear: safety. If the last few years taught us anything, it's that the world can flip upside down in a single week. So in 2026, the first thing I'd build is a 6-month emergency fund. Cash that isn't in stocks, isn't in crypto, isn't locked away somewhere I can't reach. Here's the twist though. With interest rates still higher than pre-pandemic levels, high-yield savings accounts and short-term treasury bills are actually paying real returns, sometimes north of 4 or 5%.
And the interest on those T-bills is exempt from state and local taxes. This isn't dead money, it's peace of mind. And peace of mind is the greatest investment edge you'll ever have. Because without this foundation, one unexpected event can force you to sell your best investments at the worst possible time. Once that foundation is solid, we build the frame. Step 2 is diversification. In a world with so much policy uncertainty, you cannot afford to have all your eggs in one basket. This means a smart mix across asset classes, resilient equities in sectors less tied to economic cycles, like cybersecurity and healthcare, fixed income, because as rates are expected to be cut, the price of existing bonds with higher yields will rise, and maybe a small allocation to commodities as a hedge. The goal isn't to predict the single winner, it's to build a portfolio that can weather any storm. With our defenses in place, we can go on offense. Step 3 is investing in the undeniable megatrends.
And the biggest trend of our lifetime is artificial intelligence. This isn't just about buying big tech stocks. It's about finding the companies using AI to fundamentally change their business. We're already seeing AI slash hospital misdiagnosis rates by 15%. We're seeing it cut unplanned downtime in manufacturing by a quarter. Find the companies applying this technology because that's where the real, sustainable growth will be. Look for the innovators in cloud infrastructure, enterprise data, and digital transformation, the picks and shovels of the AI gold rush. So that's the blueprint for 2026, a strong foundation of cash that actually pays you, a diversified frame that protects you, and strategic investments in the technologies that will define our future. The headlines will scream, the markets will swing, but with a clear plan, you don't have to react to the noise. You can simply execute your strategy and turn uncertainty into your greatest advantage.
Once the foundation's set, it's time for the engine, stocks. But looking ahead to 2026, the stock market isn't about just picking companies anymore. It's about understanding the powerful themes that are shaping the entire decade. The first major theme is the AI productivity boom. And no, this won't look like the hype cycle we saw back in 2023. By 2026, AI stops being a buzzword and becomes infrastructure, the new plumbing of the global economy. For this, I'd pair broad market index funds with a small, focused slice of AI infrastructure itself. Think cloud compute, chip manufacturers, and the cybersecurity firms protecting it all. My strategy would be to invest in the companies building the roads, not just the ones driving on them. The second theme is what I call the global rebuild. All around the world, governments are pouring billions into massive projects, from clean energy grids to bringing semiconductor manufacturing back to their own shores. This isn't about politics, it's just math. A tidal wave of capital is flowing, and my goal would be to follow it.
The third theme is the quiet giants. These are the boring sectors that always seem to outperform when the world gets noisy. Healthcare, defense, consumer staples, the things people need no matter what the market is doing. They aren't flashy or exciting, they're just incredibly dependable. But here's the critical part, the place where most investors really mess up. They hear these themes and they start chasing trends instead of building balance. The reality of 2026 requires a more disciplined approach. I would keep the vast majority of my stock portfolio, say 80%, in broadly diversified index funds. That's the core. Then I'd use the remaining 20% to responsibly explore these high-growth themes we just talked about.
With that core in place, we can add the optional layer, the part people argue about endlessly: real estate and alternative assets. On the real estate front, with interest rates expected to have eased off their peaks, I'd be looking for markets where prices haven't fully rebounded yet. I'm not talking about flipping or wild speculation. I'm talking about finding steady, cash-flowing properties, especially in cities where the population is growing, but the housing supply is shrinking. Then you have alternatives. This is where things get interesting. A mix of commodities, maybe some real estate investment trusts, even a touch of gold. This isn't because I'm predicting the end of the world, it's because the hedge matters most before you think you need it. This final layer is what protects the entire portfolio when everything else breaks. It's the silent guardian in your financial plan. You may never stop to thank it on a good day, but you'll always be glad it's there when the storm hits.